What's on your holiday wish list?
Roasted pistachios from Nuts.com.
Dark chocolate covered almonds.
Glazed red cherries for my holiday cake. Make your wish list come true at your holiday snack shop, Nuts.com. Delicious nuts, dried fruits, sweets, and gluten-free treats. Plus, you can enjoy free shipping on your first order. Whatever yumminess is on your or your loved one's wish list.
The box of Winter Wonderland.
The sweet and salty tray. You'll find it at Nuts.com with free shipping on your first order.
What if you could cook amazing food with very little effort every night? Brava simplifies the art of cooking so that you can make time for the things that matter most. Visit brava.com for more information.
I'm Alex Steele in for Jonathan Farrow. This is the countdown to the open. We're just moments away from the start of trading on Wall Street. We're looking to a pretty grim day. Everything really in the red. The Russell 2000 getting hit quite hard, down by 3.4%. NASDAQ futures also getting hit, and the S&P off by 1.2%. Mostly everything is actually going to be in the red, except for something like Moderna and Novavax, which is rallying on the vaccine hope. So let's look at some other asset classes here. You're taking a look at not a lot of safe haven bid within the FX and the bond market, which is quite interesting. 112 is where we are with euro dollar, up by 0.5%. I have to wonder if we're looking at some kind of divergence play. We have the double whammy here in the U.S. of getting hit with Omicron, as well as what's happening in D.C. Europe is a little bit of a different story. Are we seeing some of that re-rating, or is this central bank divergence that we're seeing as well? Yields pretty much go nowhere. Barely a safe haven bid. 138 is where we sit on the 10-year. Talk about risk off. Just look at commodities. Crude getting really whacked here, down by almost 5 percentage points. If you're instituting travel curbs, if Davos in Switzerland isn't happening, how are you going to use your jet fuel, use your gasoline? You're not, and you're seeing gasoline as well as oil get hit quite hard. So it's an uncertain year ahead, no doubt. Feeling a wide range of forecasts on Wall Street. Goldman Sachs' David Costin charting S&P path to 5,100.
All these issues, yet profit margins in the United States across every sector are at record high levels. Managements have been very nimble in basically dealing with these issues. And so we look into 2022, earnings up around 8%. Largely, the economy is still growing at a decelerating pace, margins increasing slightly. That is the story for 2022. You have a flat valuation, in my opinion. That's how you get to 5,100, or up roughly 10%, maybe 11% total.
Lori Calvasina, Brian Vendig, and Bob Dole still with us. Bob, your call for next year.
I think it's going to be a year of churning. I agree that the consensus around earnings is very tight, and I'm in that camp too, high single digits. The question is the multiple. I think as inflation, interest rates move higher, P's will be under pressure, so I'm calling it a year of churning. Going to be tough to make money.
Lori?
So we're similar to Costin and similar in thinking to Bob, maybe a little more constructive than Bob, but I'm at 50-50 for next year. I think you get 9% earnings growth. I basically got a flattish multiple right now. The risk there is to the downside. But look, I think companies have told us time and time again and shown us time and time again that they can manage around these issues, and they've not been phased so far by Omicron. So we actually agree with Bob, you can get a little, or David rather, that you can get a little bit of margin expansion next year, and that should ultimately help stocks along with a strong economy.
Brian?
We think the market has a chance to have a return more than 5%, but less than 10% next year. However, we have to be extremely selective, obviously from a valuation perspective, but we still see demand exceeding supply, and we're still going to be optimistic over the next 12 months.
I feel like the three of you perfectly highlight the confusion in the market, like why the dispersion is so great within forecasts for the S&P 500, which leads me to what you've all been talking about, which is volatility and seeing a lot of whippy price action. Lori, how do you manage the vol?
So look, we want to stay very, very balanced in terms of our sector allocations on a 6 to 12 month view. Near term, we think that we, or I say intermediate term rather, we're going to come out of this sort of shorter term issue with Omicron and these growth fears that are developing. We'll reprice the Fed, and I think cyclicals will have a nice run. But we do think by mid-year you're going to have tapped out that valuation opportunity, and we're going to be transitioning more back into the growth stocks that are under pressure right now. I would say don't try to play every little twist and turn. Buy the best of both buckets, shift back towards high quality, be valuation sensitive, and be patient.
Bob, how do you play the volatility?
Lori just made a lot of great points. I agree with all of them. The only thing I would add is, you know, when the market gets smacked hard over a period of time, if the year's going to be volatile, do a little buying when it's really hard and your stomach doesn't want to. And conversely, on the other side, when we get nice rallies, don't be afraid to take some money off the table.
All right, real quick, Brian, for you too. What do you do with volatility? Where do you hide out?
We've been using non-traditional asset classes as a hedge for inflation and some of this volatility. So looking at the private markets as well as looking at real estate, and at the same point in time using some sectors of the economy as a hedge when thinking about the interest rate put, you know, moving forward. So financials, small cap stocks actually we find attractive moving forward when you think about the reopening trade. So again, still looking at those sectors to try to capture opportunity over the last couple of weeks.
All right, let's go to where some have been playing the safety trade, and that's tech. And the NASDAQ was getting real beat up today, continuing its decline after the worst week it had since October. Abigail Doolittle is here with more. Hey, Abby.
Hey there, Alex. Well, it's really interesting because we do have that NASDAQ underperforming over recent days, the last 3 days, the worst 3 days since May. That's the degree of selling that we are seeing. And relative to the tech sector, Oracle is a piece of it today, and we, of course, have had a report over the last hour or so that Oracle is close to acquiring Cerner, that medical software company, for more than $30 billion in cash. So that's another piece of weakness. But take a look at the big tech names that had been loved, now maligned: Apple, Tesla, NVIDIA, Palantir, all down sharply, taking that sector with it. Yields are basically flat. Now, if we take a look at the true tech sector, which think Apple, Cisco, Oracle, relative to the communication sector, Google, Twitter, Facebook, you're going to see that the communication services index has been down far more than the tech index as of late. That said, they're both up about 20% or far more relative to the actual tech sector on the year. And of course, yields could provide a reprieve when yields are lower. The narrative this year has been that's helped out tech and those mega cap internet names. That simply has not been the case recently. What we're looking at in white here, the 10-year yield coming in a little bit, but you can see really range bound. The S&P 500 relative to the tech index, or relative to tech, is higher, meaning that tech has been underperforming recently relative to yield. So it's interesting to see that little bit of narrative, that dynamic shifting a little bit. Perhaps some year-end positioning, Alex, but lots of moving pieces, so much uncertainty.
I know. It's so hard to really get a clean read-through of what's happening with the markets. S&P now below its 50-day moving average. Abigail Doolittle, thanks very much. Well, Market Field's Michael Shawool weighs in on that outlook for tech.
The strange thing about technology is that there's a portion of it. It's not the leadership. It's a sort of second-tier tech, the new of the new. You know, which is in a very clear bear market. If you continue to have this divergence between those two pools, that's really not a problem. But if you start to see, you know, people joining lines between some of the larger cap, you know, sort of blue chip technology companies and some of, frankly, the fluff that got issued, then I think, you know, you have a recipe for a much more difficult 2022 for that sector.
Lori Calvasina, Brian Vendig, and Bob Dahl still with us. Hey, Brian, blue chip, large cap tech stocks, that has been where you want to be. Is it going to be still the place you want to be for 2022?
I think it's part of the portfolio for sure. I mean, our society is so pervasive in the way that we use technology and software. So I still think it makes sense to have the leaders in that sector as part of your portfolio, but you need to stay broadly diversified, as we were saying in the previous segment, Alex, you know, looking at cyclicals, looking at basic materials, industrials, financials to pair with that, in my mind, makes the most sense, because we're going to continue to see a lot of variables play out, and that's going to continue definitely over the first several months of the new year.
Bob, you're definitely one of the most skeptical on the panel today. Where does tech fit into this?
I'm neutral on tech, Alex. They've had great runs, strong profitability, but it's a big sector, so you got to own something. My favorite mega cap one is Google, but I'm willing to play some value names like a Dell computer.
Lori, your take on tech? You said it was getting hit the hardest, yeah?
Yeah, so look, in the intermediate term, this sector is going to continue to take its lumps. It's one of the most expensive parts of the market, and expensive stocks underperform when rates are rising, and investors are repricing the Fed right now, and that process has simply got to play out. But if you're an investor longer term, I think you want to stick with this sector. I think it's going to do well in the second half of the year once the valuation's correct. It's the highest quality sector in the market, and that is where you want to be longer term. So it's time to decide with tech. Do you want to be a trader or do you want to be an investor?
Oh, no, that's a good headline there. Okay, let's talk about where else you want to be in the safety trade here. Wells Fargo Chris Harvey is looking ahead to next year. He's been writing recently that we expect a healthy repricing of risk, therefore an increasing probability of a 10% market slump by during summer 2022. Rising optimism and froth and decelerating growth creates instability. That kind of echoes a lot of what Lori and Bob, you guys were talking about. So I want to get your number one safety trade. I mean, usually you're going to want to be in bonds. I don't know if that's going to provide the kind of lift that we're all looking for. Bob, what's your call?
Safety trades, AT&T you mentioned earlier, own that name. I like the managed care area, CVS, I think is a conservative name. I don't know if there'll be safety trades, but you got to own some financials if you believe rates are going to go up and the yield curve might steepen again.
Well, the yield curve trying to steepen a little bit today. How about you, Brian? You talked about alternative assets. Is that going to make up like some of the 40% of that part of your portfolio that bonds just can't deliver this kind of returns we're looking at?
Alex, I definitely believe so. I mean, that's our way to hedge volatility as well as inflation and some of the interest rate risks. So again, taking a look at the real estate sector as an example, industrial sector real estate assets such as warehouses, logistics centers, apartments, as well as life and health science buildings. These are things that are going to be in demand and can help to provide some stability where traditional bonds would be absent, I think, next year with rates going up.
Lori, what kind of role does bonds play in your portfolio?
So look, we just look at it from the equity perspective, and I would just say on the topic of safety trades, I would look at healthcare and staples over REITs and utilities. I think you've got attractive valuations on the staple side. You do have some supply chain issues, but they're very well managed around healthcare, less supply chain risk, but probably not as cheap valuations. But both are much, much higher quality than what we see in the REITs and utility space. So I would stick with those two for defensive purposes.
Fair enough. Hey, guys, I'm looking at the market here. The S&P is up by 1.4%. You have the NASDAQ up by 1.5%. Volume, though, is really mixed. And I'm wondering, Bob, when are we going to learn what the correct read-through is of everything that's happening now, from what's happening at the Fed to D.C. to Omicron? When do we get the clean read?
I don't think that's going to come anytime soon, Alex. It's a very confusing period, lots of cross currents. It's year end when you get all kinds of cross currents anyway. So I think this uncertainty and confusion and volatility and churning is going to be around for a while.
Brian, when do you think we get the read? What are you looking towards?
I would say as we get through corporate earnings in January, and then obviously towards the end of March when we get our first Fed decision on rates. I mean, I think we're going to be in a period of time, as Bob said, where there will be a lot of variables and a lot of cross currents playing out. But I think right now, that's why when you think about sectors and allocations, you need to be fairly balanced across the board, recognizing this is going to be a period of time. Just like we saw from first quarter to second quarter of this past year, things can change quite quickly.
Indeed, it can. But do it a couple more months now, that's going to be a lot. Brian Vendig, Bob Dahl, guys, thanks a lot. Really great to see you. Lori Calvasina is going to be sticking with us. Coming up, small caps extending their declines, falling deeper into correction territory. What do you do with them next year? Our conversation up next. This is Bloomberg.
is oxygen.
This is Bloomberg's The Open. I'm Abigail Doolittle. You're looking at a live shot of the principal room. Coming up, Douglas Holtz-Eakin, American Action Forum president, former CBO director, and former Council of Economic Advisors chief. This is Bloomberg.
When you look at what's going on under the surface in small caps right now, what is really curious to us is a value trade has actually emerged. Small cap value has been dominant over small cap growth over the last 4 or 5 weeks. Again, kind of an unusual development given lower yields, given risk aversion. So there's something brewing here. A lot of the clues this year have come down cap. So the fact that we're seeing small cap value outperform here, I actually think may be a very early sign we're setting ourselves up for maybe a large cap value trade into 22.
Rising COVID concerns fueling fresh uncertainty about the economic recovery, and that's all pressuring the Russell 2000, falling deeper into correction territory since hitting a record high back in mid-November. Want to bring in for more Bloomberg's Kelly Lyons. Hey, Kelly.
Well, Alex, it's not just the Russell 2000 more risky small caps that are feeling the burn of this. Pretty much anything you would classify as a speculative asset has as well, and that includes a number of baskets within the equity market, including newly public companies, SPACs, meme stocks, if you will. You can see a basket of IPO stocks now down about 16% over the last year, while the China Golden Dragon Index, which of course houses Chinese stocks listed in the U.S., is down more than 40%. Granted, there are some idiosyncratic factors there, some regulatory concerns stemming from Beijing, but by and large, it's a story of if it has a high multiple, it is called a bit into question given we may be heading into a higher rate environment. Of course, one of the poster children of this has been the ARK ETFs, Cathie Wood's funds that had such a stellar 2020 and have had a really rough go of it in 2021. What we're looking at here is a chart on the terminal that shows the flows for the ARK family of funds. And you can see the massive inflows these were seeing at the tail end of last year, even early on in this year, and that has quickly turned into a story of outflows really consistently since October, as of course the ARK's funds like the flagship fund, the ARK Innovation ETF, have down about 22% on the year. A lot of those high-flying, high-multiple stocks, not necessarily something investors want to own in this environment. And finally, just bringing it back to the small caps, looking over the last 30 days, the Russell 2000 is down the better part of 13%. And year-to-date, this index is only up about 10% relative to the 23% gain we saw for the S&P 500. So that consensus call for small caps over large this year, Alex, not really one that played out as everyone was expecting.
Yep, Kelly, thanks a lot. Kelly Lyons joining us. So RBC Lori's Calvasina seeing a strong start to the year for small caps, writing, quote, "We've been looking for another burst of outperformance in small caps in early 2022 before large cap leadership resumes later this year." Lori still with us. What's going to trigger the burst here?
So look, first and foremost, we've got to get past this period of short-term uncertainty associated with COVID and Omicron all year. And I think this is what killed the small cap trade back in March and then again in November. But if you look all year, large versus small relative performance has been trending in line with the rate of change in COVID cases in the U.S. And we actually saw that small caps in November were starting to break out, really starting to get excited about another strong economic year when COVID cases in Europe started to spike. So we've got to get past that. Now, once we come out of that and we start playing recovery trades again, I think small caps are going to cue off the stronger economy. They tend to outperform when GDP is running above 2.5%, which is the long-term historical average. We also find that when rates are rising, and that's what markets are really anticipating, that cheaper stocks tend to outperform. And as Kaylee mentioned, small caps are really looking incredibly undervalued at this point in time. And a lot of that undervaluation is driven by things like financials. So I think those two things, once we kind of get past the short-term growth concern, is going to allow small caps to really just explode to the upside.
Is it growth or value in small caps or both?
I think that at this point in time, you're looking more at the value part of small cap. And if you look at where the deepest valuation opportunities are, it's not in things like defensives. It's really more things like financials, energy, material, even consumer discretionary, which is more on the cyclical side in small cap, is something that's really contributing to that small cap undervaluation at this point in time.
We talked earlier, Lori, about where retail is, and retail sort of on the sidelines, a little freaking out a little bit. Does retail play into the small cap story at all?
You know, I think maybe to a lesser extent. I think that they will engage in certain small cap names and sort of wreak havoc with small cap managers' portfolios by making them become really big weights in the benchmark. And we do know that last summer, I think it was, if you looked on the Wall Street Bets board on Reddit, they were talking about engaging in small cap, but for the most part, I think they sort of live in that large cap land. I think, where we do see a lot of interesting moves in small cap is the hedge fund community and futures activity. And small cap futures positioning is a really good barometer for when to get in and out of that trade. And right now, the positioning froth has started to really come off in a big way.
Great stuff, Lori. So fabulous. Thank you very much, Lori Calvasina, joining us there. We got some breaking news for you concerning Oracle. Here's Abigail Doolittle.
Well, Alex, we had been reporting just moments ago that there was a report that Oracle would buy medical records company Cerner. Well, in fact, just moments ago, the announcement is official. Oracle is buying Cerner for $28.3 billion or $95 per share in cash. The shares of Oracle are at session lows, down nearly 3%, just recently putting in a record high, but really retreating. The shares of Cerner, that medical software company, halted at this time. We'll be waiting for that open, Alex.
All right, good deal. Thanks, Abigail. Really appreciate it. Let's look at some of the price action this morning. We're about 20 minutes into trading on this pretty grim Monday here. Here's Bloomberg's Kriti Gupta. Kriti?
Well, good morning, Alex. You're seeing all 11 sectors in the red today. It's your classic growth trade or your classic pandemic growth trade, I should really say. To the downside, let's start off here's materials, financials, energy, essentially those commodity-driven sectors that are really feeling most of the pain. To the upside, though, or I should say to the less of a downside, really your leaders on a pretty red day are going to be your consumer staples and healthcare. A lot of that led to the upside by your names like Clorox, P&G, Kimberly-Clark, as well as healthcare names like Moderna, Pfizer. Like I said, it's really all about the Omicron variant and the names that are thriving in an environment where we still have to deal with a brand new variant. I want to hit one stock in particular, one sector I should say in particular, and that is of course the travel sector, which not only is down when it comes to once again the pandemic growth rate, but it's actually been having a pretty rough couple of months, and it really all started in October with the Omicron variant, where you started to see those outflows really accelerate. And the best kind of example of that trade is what you're seeing with Carnival Cruise Lines actually reporting earnings this morning that missed the estimates. They did have kind of a better cash burn than expected. Still waiting for that profitability, though. That's really only expected to come in the second half of 2022. Alex, it tells you everything about the progress some of that travel sector is really trying to make.
Yeah, Kriti, and it also shows a lot that the vaccine makers are kind of the only ones that are managing to get into the green here. Moderna, Pfizer, Novavax. Kriti, and I just wonder, like, is this sort of more of the reopening, non-reopening trade?
Yeah, absolutely. And to your point, this really has everything to do with the fact that we are kind of in this tug of war, this back and forth between when you talk about simply the reopening trade, like you said, and the recovery trade, because once again, this variant is not clear about whether this is going to be the last variant or if this is going to be something that the longer infrastructure really has to hold. So when we're talking about this tug of war, Alex, you really nailed it. We're not 100% there where we can be really confident in that reopening trade.
Yeah, and volume a little bit mixed. Also, Kriti, thanks a lot. Really appreciate it. Coming up, the market moving events you need to be watching this week. That's next in our trading diary. This is Bloomberg. This is Bloomberg's The Open. I'm Alex Steele in for John Farrow. Quick look at the markets, guys. You're going to want to brace yourself here. The Russell Index is now down by 2.5 percentage points, getting hit the hardest. Tech also getting hit down by over 1%, but the S&P now catching up, down by 1.5. The only equities that seems to be in the green are the ones like Pfizer, Novavax, and Moderna for that vaccine play. We are seeing a bid also emerge in the bond market, diverging from what you're seeing in Europe here. The 2 and the 10 re-rating as some buying comes in, yields lower by about 2 or 3 basis points. Although you're seeing a steeper yield curve because the 30-year still sees some selling. Time now for Trading Diary. What you need to watch for this week. President Biden meeting with the COVID response team at 1:30 this afternoon. Plus, U.S. GDP and consumer confidence coming up on Wednesday. And then a host of data crossing on Thursday. You got another round of jobless claims. Plus, the UMich Consumer Sentiment Survey. That's personally my favorite. That's my desert indicator. And finally, on Friday, U.S. markets will be closed for a much-awaited holiday. That was the countdown to the open. You're looking at stocks deeply in the red. You're seeing volume not terrible. A bid coming into the bond market. The dollar a little bit mixed. Commodities getting hit quite hard as we continue to worry about Omicron as well as dysfunction over in D.C. This is Bloomberg.
For details. The moment you order the world's most delicious snacks from Nuts.com, something truly magical happens. Freshness. Your choice of fresh nuts, dried fruits, sweets, and treats are hand-selected from our kitchen. Freshly roasted to perfection or freshly baked, freshly dipped, freshly seasoned, or freshly popped. Packaged fresh, and Nuts.com delivers this yumminess super fast with free shipping. Nuts.com. Fresh snacks from our kitchen to yours.
Want to increase your home value? Find out what it's worth first.
Just go to Ownerly.com, enter the address, and see the home value instantly. Come to Ownerly.com and see what your home is worth.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the trading day in U.S. market on this Monday, December 20th. Here are the top market stories that we're following for you at this hour. It's the Manchin meltdown. Senator Joe Manchin kills President Biden's Build Back Better legislation, and Goldman slashes its first quarter growth by about 1 percentage point. And you got Davos is now canceled. The much-awaited World Economic Forum is pushed to the summer as Europe cracks down, and the UK won't rule out a Christmas lockdown. So that's the perfect storm for markets. Equities sink as investors price out a human infrastructure deal, price in a COVID scare. What is the biggest risk to markets, COVID or Manchin? From New York, I'm Alex Steele here in New York, as I just said. My co-host in London is Guy Johnson. Welcome to Bloomberg Markets. I'm in New York. Let's just be clear. Davos, though, not happening. I had the feeling that was going to be the case.
Yeah, it was blindingly obvious, wasn't it? I'm surprised it took this long for it to be cancelled. I don't think anybody looking at what was happening in Europe was expecting to travel to Switzerland, to gather in huge quantities, to have cameras everywhere posting pictures of people socializing with or without masks. What happens if you arrive in Switzerland, Alex, and you get a positive test? Even if it's a false positive, you're trapped there. Nobody, I don't think, was expecting to travel to Switzerland in January. January looks like it could be quite bumpy.
Yep, quite bumpy indeed. And I asked this question in the earlier hour, like when do we get a clear read of the markets? Because you're going to have some volatility and also volume issues over the next couple of weeks and confusion as to what January brings. And then you have earnings season. So it's going to take a while, I think, to get a clean read on where we really think inflation and growth are going to go. And that's what's going to lead the stock market and the Fed.
Yeah, the Fed, in theory, should be on rails here, getting the taper done. I wonder if there's some flexibility within that. We'll wait, we'll watch, we'll see exactly what Omicron delivers. Certainly the narrative coming out of Europe is that this is going to be a short, hopefully, it's going to be sharp. Is it going to be short? But it's certainly going to be a shock. And I think, as I say, as you said, Christmas, we're waiting to find out if we're going to get it locked down here in the UK. The Netherlands is already locked down. More certainly to follow. So that kind of, Alex, brings us on to our question of the day. Bigger risk for the markets, is it Omicron, or is it actually that we're not going to see a fiscal and monetary response this time around? And maybe that's where we come to Virginia Senator Joe Manchin. He's decided that he is not going to be backing Build Back Better. He made the interview, the news in an interview on Fox, which was interesting in itself. So let's kick this around. Joining us now, Sarah Ponczek, UBS Private Wealth Management Financial Advisor, and Anne-Marie Hordern joining us from D.C., Bloomberg's Washington correspondent. Welcome both. Anne-Marie, I'm going to start with you because I'd be interested to get your perspective on how the White House is viewing all of this. What does the White House see as the biggest threat right now? Joe Manchin basically torpedoing all of the legislation, or Omicron putting huge pressure on the president to act and do more?
I think it really depends on what lens you're looking at. If it's the lens of the legacy of President Joe Biden, potentially that is what is going on right now with Senator Manchin. This was really the centerpiece of his presidency, of his legacy, and he campaigned on the fact that he could really be the person that can bridge gaps and bring parties together. And he's struggling to bring his own party together in a big way. But obviously, as we have said time and time again, the economy and everything that is going on with the economy, inflation, this all goes back to COVID. And right now, what we're seeing spikes, not just around the world, but particularly in New York, as well as cities in America. This is going to be a very big problem for the administration as they try to, at the same time, push through their economic agenda.
So, Sarah, it brings us to you, and in the short, we'll get to the long term in a second, but the short-term outlook, what's the play? So Marko Kolanovic over at JP Morgan said this market episode may end up in a short squeeze and that you probably want to go ahead and buy the dip. What do you think?
So you alluded to this earlier in the show, the fact that we are in the midst of a holiday shortened week. We're already seeing liquidity thin. So to make any big decision right now or take away any message from the market, it's pretty harrowing, probably not the best decision. And the reality is, yes, you're asking about the short term, but if you are not a trader, if you're an asset allocator, if you are an investor, the bigger risk between the two, for your question of the day, I'd say it is COVID. We see that in the way that the market is trading today. If you do want to look at the short-term technicals and the underpinnings of the market right now, but long-term, we still believe that the outlook is pretty constructive. After all, if you do look at the way that the market has been trading wave after wave after wave of COVID-19, we have seen diminishing effects. And right now, yes, data is very limited. It's very early days, but the understanding is that as of right now, the Omicron wave will likely bleed into that of the Delta wave.
Sarah, this time's different though, isn't it? Because previously we've had huge amounts of monetary support, we've had huge amounts of fiscal support. We're not going to get either this time around.
You're right. This time is different because last week the market's already contending with the effects of a hawkish pivot from the Federal Reserve, and then you throw in the headlines this weekend, more on Omicron, and then more as well on the Biden economic agenda. We see roadblocks there. So yes, you're right. This time is different. But what is not different is the fact that the Federal Reserve, while yes, they have made a hawkish pivot, they've said over and over and over again that they will remain nimble, they will remain flexible. Just look at the change that we saw from Powell and Co. between September and last week. I mean, it was a world of a difference. All of a sudden, the dot plot shows 3 hikes expected for next year, but we all know the dot plot can change, and what we are expecting right now from the Federal Reserve is not written in stone. They can change if need be, and the reason that COVID and Omicron is really such a concern is that when you think about 3 of the main risks right now, Omicron and COVID, a policy error from the Federal Reserve, and inflation, the 3 are all very much intertwined because of how Omicron can potentially affect global growth and how it can also affect supply chains.
Right, so let's dig into that, Anne-Marie, because we're talking about the removal of Fed support, we're talking about the removal of government support in essence. Does that conversation need to be rethought in D.C.? I mean, the child tax credit is expiring at the end of December. Do you think we're going to get some kind of action from the White House in support if Omicron just continues to pummel the U.S.?
Well, right now what we do know is that when it comes to the economic agenda, that Senator Schumer says that he's going to bring that vote to the floor in January 2022, and that any senator can make their position clear to the world on the floor of the chamber instead of in front of the television cameras. Clearly a dig at Senator Manchin. And what they're going to be doing tomorrow on Tuesday is discussing, this Democratic caucus, a path forward. Potential we could see is some policy points, like you mentioned, the child tax credits. Potentially some of these could get passed. And there is a version of Build Back Better that is only a few policy points, but supported for a longer period of time. And that's kind of what Joe Manchin was getting at this weekend with his interview. But this is going to be incredibly difficult because the president's credibility is on the line with the progressives who voted yes for the hard infrastructure with the promise that he was going to deliver on the massive social spending and tax plan. And right now, it does not look like that path is possible.
Anne-Marie, did the arithmetic in the Senate change this weekend? We've been assuming that Joe Manchin is a Democrat. Should we now be thinking of him as an independent? And what are the implications of that?
Well, it's not just this bill that they desperately need Senator Manchin for, right? If the Democrats want to do anything alone, they need every single senator that caucuses with the Democratic Party. And right now that's 50, and of course the tie-breaking vote from the vice president. But Senator Manchin has been saying this for weeks. He's been struggling with issues happening right now in the world, and he talked about this subsequently in his press release following that interview. Inflation, the COVID pandemic, the uncertainty of where that goes, and geopolitical concerns, and making sure they have firepower to address these concerns and not spending on other issues. And that's really the crux of what he was getting to. He's still going to caucus with the Democrats, but he's clearly on the right side of that party.
Right, but he loses all power if he goes out of the Democratic Party. Right now, everything hangs with him. I was having that exact conversation over the weekend. Hey, Sarah, a last question for you, just sort of the market moves right now. I'm so interested in the stocks that are actually in positive territory right now. Carnival, American Airlines, Royal Caribbean. At the same time, you have AT&T and Clorox. Am I learning anything about a reopening, non-reopening, COVID, non-COVID trade right now?
Not necessarily. Typically, whenever we get strong headlines about COVID-19, as we have really over the past 2 years or so, we see this classic trade in which reopening stocks move to the downside and your stay-at-home stocks outperform. But as you just mentioned, that's not necessarily what we're seeing. We're not seeing the playbook play out per se right now. But again, very thin holiday trading right now. You can't take away too many messages. And when we think about where we want to be heading into the next year, if you're going to take a little bit of a tactical shift, yes, some of the areas that you just explained are very beaten down, even though indexes, the S&P still isn't even 5% from a record, but we still favor the cyclical value trade.
All right, and we're going to get to those longer-term views right after this. Anne-Marie Hordern, thank you very much. And Sarah Ponzik of UBS, you'll be sticking around. We're going to talk about what you're telling your clients about those longer-term prospects. We're looking at S&P, though, sort of kissing around that 100-day moving average, slipping below the 50-day. This is Bloomberg.
Is oxygen.
Interest rates are still zero, but the Fed has said, we're going to take the punch bowl away. We can all debate the pace of that, but the Fed is moving from our best friend, and they will eventually be our worst enemy when it comes to the markets.
That was Bob Dole, Crossmark Global Investment CIO, earlier on Bloomberg Television. Sarah Ponzik, UBS Private Wealth Management Financial Advisor Associate, is still with us. Biggest friend to biggest enemy, is the Powell put dead?
I don't know if it's necessarily that black and white. Is the Fed going to be the market's absolute best friend forever anymore? Maybe not. As Bob Dole did say, they're going to be taking away the punch bowl. But are they going to become the market's worst enemy? I'm not so sure. After all, when we think about what the Fed messaged last week, yes, right now, we're expecting 3 hikes next year, then potentially 3 hikes the following year. But when you consider right now, Fed funds rate is as low as it can possibly go. Well, that is, unless you were to go negative, but a Fed's fund rate near close to zero, even if you get 3 hikes next year. And what we assume is that we won't see a hike of more than 25 basis points a quarter, so at a slower pace, then monetary policy at the end of that is still relatively accommodative. So even in a world where interest rates are rising and the Federal Reserve is not your best friend anymore per se, it's still a world where it's almost as if there still is no alternative because yields will still likely remain relatively low compared to history.
Sarah, when you think about inflation, you think about the narrative we're going to be working with throughout next year. where do I want to sort of take advantage of that story that isn't already priced right now? We've started to see people, you're moving out of big tech. There's certainly some evidence of that. I hear a lot of conversations about kind of you want to buy infrastructure, you want to buy those kinds of places, real assets. Is there any area that isn't tapped yet in terms of providing protection on the inflation front? Where's the cheap inflation protection still?
It's a good question, because if you do look at least at different sectors of the equity market that would be levered or tied to the inflation story and the reopening, much of that has been played out. You look at financials, for example. You look at energy, for example, real estate. These are all areas of the market that have outperformed in 2021. However, when it does come to cyclicals and value, we do believe that has more juice, that we could see financials and energy, for example, continue to outperform. At the same time, if you move away from equities, an area of the market that we like, and not even just for the inflation story, is private credit. That is a way, and yes, the reach for yield is very real in a world where there still is $13 trillion of negative yielding debt. That's an area of the market where, one, you're talking about private credit, so you get a little bit of a liquidity premium. The yield's typically higher, but much of them are also issued with a floating rate structure. So as interest rates do rise to combat higher inflation, you move along for the ride too.
Hey, Sarah, I'm wondering what you guys are looking at as the bigger risk. One is that Omicron actually pushes back any kind of Fed rate hike, because they're going to have to signal relatively soon if they're going to do March. Or the other, in that they have to hike a lot faster or a lot bigger at each meeting, over 25 basis points, for example.
If I had to decide between the two on the spot, I would say the latter, that Omicron really enforces inflation concerns. You know, the idea that on the one side, it could hinder global growth, but on the other side of the equation, supply chain constraints remain, and we continue to see elevated inflation, forcing the Fed to act faster in a slower growth environment. That is likely the bigger risk, because yes, typically if you look at history, stocks and risk assets, can weather Fed rate hikes, but it really depends on where that is relative to the economy. So the latter of what you said, Alex, I would believe is the bigger risk there.
Sarah, how vulnerable would the market be to an accelerated hiking cycle? We've already doubled the taper, but there is this expectation, and you laid it out earlier on in the conversation. We're actually getting some IB questions on this as well. The expectation is that we hike reasonably incrementally, 25, 25, 25, then 25, 25, 25. If inflation proves to be more sticky, what is the risk that we end up having to do more? And as we've seen with the taper, the Fed actually kind of just ups the quantum in terms of the hikes that we're seeing.
That is one of the biggest risks right now, and something that I think is so front and center right now is the fact that when we do think of those largest risks for 2021, being inflation, being a Fed policy error, and being COVID-19 continuation, the three of them are also intertwined so tightly. So if the path of one changes, the path of another may change as well. However, I will say, we do expect that the market will be able to weather the current expectation of Fed tightening. And at the same time, the Fed has made very, very clear, again, that they are nimble, they are flexible. They do not want to be the cause of a rollover in growth, a rollover in equity markets. Of course, though, the stock market is not one part of their dual mandate, but they're very in tune with markets. And we saw that last week, too. Yes, the Fed made a hawkish pivot, but what did they do? They really only brought their expectations in line with what the market was already expecting. So they listen to what the market tells them.
It's a good point. All right, Sarah, a last question for you. Taking a look at the bond market, a nice bid in the belly in the front end here. But I just wonder what the right safety trade is right now. It's going to take a couple weeks for us to get a clean read on the market. Where do you hide out if you need to?
Look, we still believe that bonds do make up an important part of investors' portfolios. It's a question we get time and again now because yields are so low and the bond market, yes, it's overvalued. Why hold bonds? But it still provides stability, still provides diversification. And something that is amazing to me is the fact that pre-FOMC meeting last week, 10-year was at 144, your 2-year was at about 0.66%. Well, even with a hawkish pivot, both yields are below that today.
Sarah, have a great Christmas. Enjoy the holidays. Thank you very much indeed. Sarah Ponzek of UBS Private Wealth Management. What are we going to be talking about next? Omicron spread certainly casting a dark cloud over the holidays. Vaccine makers mixed, some under pressure, as you can see. Earlier on, certainly the futures were indicating that a lot of these stocks would open significantly higher. We've certainly seen a fade off that. We'll deal with the details next. This is Bloomberg.
/access.
It is time now for your Bloomberg Business Flash to look at some of the biggest business stories in the news right now. I'm Alex Steele. Oracle is making a bold move into the healthcare industry with its biggest deal ever. The company has agreed to buy medical record system provider Cerner for about $28.3 billion in cash. Oracle will be adding a broad customer base to bolster its cloud computing and database businesses. And staying with M&A, Monday, the Bank of Montreal spending billions to expand its presence in key U.S. growth markets. It's agreed to pay $16.3 billion to buy BNP Paribas Bank of the West unit. That should add about 1.8 million customers when the deal closes next year. BNP plans to return some of that cash to shareholders through a buyback. And Elon Musk says he will pay more than $11 billion in taxes this year. That could be a record payment to the U.S. IRS. The world's richest person and Tesla CEO has been selling millions of shares to cover taxes relating to the exercise of Tesla stock options. And that is your Business Flash. Okay, $11 billion, that's a pretty solid tax bill.
Yeah.
Sure, okay.
Biggest one in history. It is, you actually step back and think about that. But he's had an incredible year. A lot of people were pouring cold water on those, including us, that suggested he's Person of the Year. Elon Musk has had an absolutely incredible year. Though I do take you back to that poll he ran, Alex. Should I not sell stock? I think he probably had to sell the stock. Not entirely sure.
To get $11 billion, I'm guessing, yeah, unless you got that sitting in your bank account.
Who doesn't, to be honest?
Yeah.
There's some really interesting trends developing in this market right now. So the vaccine makers aren't doing what I thought they would do today. I thought they would have a much more positive day. Travel stocks really not getting beaten up at all. Now, they've already been beaten up. Anyway, Novavax is giving up some of its earlier gains. Obviously, we've got the Moderna news in terms of the impact its booster shots are having. Let's wrap it all up. Krithi Gupta looking at some of the biggest movers.
Well, Guy, thank you. Well, it started off the way you thought it would, in that some of these vaccine makers actually did post some pretty good opening gains. Novavax up almost 7%, Moderna as much as 6%. But you started to see some of those gains pair off a little bit. But let's dig into the details here. The obvious is simply that we're dealing with the Omicron variant, and Moderna in particular announced that their own vaccine combined with the booster, that third shot, actually gives you additional protection against this particular variant as they're still developing some of their own kind of additional shot to specifically target Omicron. Let's just dig into the numbers here. The 50 milligram dose, that is the normal amount for the booster. And you can see even with the booster, it increases it 37 times in terms of your immunity. Compare that to the 100 milligram dose, which is not the traditional amount. And you see an even bigger number, 83 times more immunity. So that's going to be a key piece of the equation. Remember, this is measured 29 days after the shot, but that's just Moderna. You also had a New York Times story come out this morning saying that Moderna and Pfizer are going to be the best vaccines compared to all of the other ones in terms of that protection. Let's quickly look at Novavax, though, because this is a vaccine that just got regulatory approval over in Europe. It's still waiting on the FDA filing by year end here. The question here, though, is they're not using the same technology that Moderna and Pfizer are. Some people are saying that this is going to help with that vaccine hesitancy.
All right, Kriti, thanks a lot. Really appreciate it. Thank you very much, Kriti Gupta, joining us from Bloomberg. Tune in tomorrow because we're going to talk to Stan Erck, Novavax CEO. That's coming up at 11:30 in New York time tomorrow, 4:30 p.m. in London. Definitely do not want to miss that. Coming up, more efforts to rein in Omicron's spread. We'll talk to Dr. George Rutherford of the University of California, San Francisco. This is Bloomberg.
What's on your holiday wish list?
Roasted pistachios from Nuts.com.
Dark chocolate-covered almonds.
Glazed red cherries for my holiday cake. Make your wish list come true at your holiday snack shop, Nuts.com. Delicious nuts, dried fruits, sweets, and gluten-free treats. Plus, you can enjoy free shipping on your first order. Whatever yumminess is on your or your loved one's wish list.
The box of Winter Wonderland.
The sweet and salty tray. You'll find it at Nuts.com with free shipping on your first order.
You're in sales. Stop wasting time searching the web to find emails. PeopleSmart.com is the faster way to find emails and phone numbers for your business. Saving time means closing more deals. PeopleSmart.com. Start prospecting faster than ever today.
We're out into we are an hour. Let me start that again. We're an hour, as you can see by the clock, into the trading session over in the United States. That's what happens when you try and speak too quickly. Abigail Doolittle is going to slowly and calmly take us through the price action.
Well, the price action isn't so calm itself, Guy. Let's take a look at the major averages here in the U.S. because we have a bit of a sell-off. The S&P 500 down 1.7%. That NASDAQ 100 off of its lows, but nonetheless down 1.3% over the last 3 days, really sliding, the worst 3 days since early May. So this risk-off that we feel that we've had recently accelerating, especially for tech, also for small cap, with that small cap index really breaking down a range, a year-long range, not looking so pretty right now. And then China tech, of course, the NASDAQ Golden Dragon index down 4.2%, down more than 40% on the year, more than 50% from its peak, and right now its lowest level since March of 2020. Now, one question is that what is going to happen for U.S. tech? We obviously don't know. We're at the year end with the uncertainty around the virus. But one thing that's super interesting about the tech sell-off that we're seeing both in the U.S. and China, this is the 10-year yield over the last 8 trading days or so, and you can see really coming in down 13 basis points. So perhaps a bit of a bid for bonds here, given the fact that the Fed is actually more hawkish, suggesting that rates are going to go higher. That's not what we're seeing with the 10-year yield right now. Nonetheless, its year-long uptrend is still in place. Let's see what happens there. However, if we compare the S&P 500 chart to this 10-year yield, it's pretty interesting.